Hey, it's Darius, and congratulations to I-75ers who let me know that they passed the CPA exam in November. The green check marks mean they're done. No more CPA review for them. But what about you? Maybe you just need to get on the right road. Go to i75cpareview.com, click Get It Now, and take advantage of our Black Friday specials. Get the lowest prices of the year. So get on I-75 with me, Darius Clark, because the right teacher makes all the difference. I'll leave a spot for you on next month's list. Hey, it's Darius, and congratulations to I-75ers who let me know that they passed the CPA exam in November. The green check marks mean they're done. No more CPA review for them. But what about you? Maybe you just need to get on the right road. Go to i75cpareview.com, click Get It Now, and take advantage of our Black Friday specials. Get the lowest prices of the year. So get on I-75 with me, Darius Clark, because the right teacher makes all the difference. I'll leave a spot for you on next month's list. All right, what do we have to know about pushdown accounting in a business combination? So pushdown accounting occurs when a company that has been acquired adjusts its own separate financial statements to reflect the acquirer's purchase price allocation. So on the subsidiary's books, pushdown accounting is optional, but if selected, the acquiree, the subsidiary, pushes down the parent's basis. That means the fair values of the sub's assets and liabilities will record that on the subsidiary's own books. They call it pushdown because these fair value adjustments that were recorded on the consolidated financial statements at the time of acquisition are getting pushed down now to the subsidiary's own books. This is an election made by the subsidiary, not by the parent. But if it's made, then the acquiree replaces its old carrying amounts with the parent's new fair value for all the acquired assets and liabilities. That means the subsidiary will value the assets on its own books at fair value at the date of acquisition. And then the subsidiary will also record goodwill directly on its own books, even though it did not pay anything. So pushdown accounting is allowed when a change in control occurs, when the acquirer, the parent, obtains greater than 50% ownership of the acquiree, the sub. And if the sub prepares its own separate financial statements, they could elect pushdown accounting on those separate subsidiary financial statements. And if so, the subsidiary revalues their identifiable assets and liabilities using fair value, not carrying amount. Same fair values that the parent used in its purchase price allocation, which could result in goodwill. And if so, the subsidiary will recognize goodwill the same amount that the parent recognized on the consolidated financial statements. You'll end up seeing that goodwill in both places, on the consolidated financial statements and on the subsidiary's own separate financial statements, only if pushdown accounting is elected. Because remember, it's optional, it's not required, but once elected by the subsidiary, the choice is irrevocable. So know something about pushdown, because they could ask you. All right, when an acquired company elects pushdown accounting, how are its separate financial statements affected? A, they continue to reflect the acquiree's historical carrying amounts. B, they're adjusted to reflect the acquirer's purchase price allocation and fair value basis. C, only intangible assets are adjusted to fair value, not the tangible assets. D, only liabilities are adjusted to fair value, not assets. And the answer is B. Under pushdown, the acquiree, that's the subsidiary's separate financial statements, are restated using the acquirer's purchase price allocation. This means the acquiree, the sub, records a new basis of accounting, including assets at fair value, liabilities at fair value, goodwill, if any. Therefore, the acquiree does not continue using historical carrying amounts once pushdown accounting is elected. And the question asks, when an acquired company elects pushdown accounting, how are its separate financial statements affected? And the answer is B. They're adjusted to reflect the acquirer's purchase price allocation and fair value basis. All right, so we know the assets and the liabilities of the subsidiary would be impacted if Pushdown is elected, but so is retained earnings of the subsidiary. It's usually eliminated and replaced with an account called additional paid-in capital dash Pushdown. Now be careful because we know that on the consolidated financial statements, all the subsidiary equity accounts are eliminated. But in the subsidiary separate books, that's where we are right now, if Pushdown is used, retained earnings gets eliminated and replaced with APIC-Pushdown. The other subsidiary equity accounts are not eliminated in a pushdown situation on the subsidiary's own books, but retained earnings is eliminated if pushdown is selected. All right, in a business combination, if pushdown accounting is selected, which of the following accounts are impacted on the subsidiary's separate financial statements? A, subsidiary assets and liabilities are adjusted to fair value and subsidiary retained earnings is increased. B, subsidiary assets and liabilities are adjusted to fair value and all subsidiary stockholder equity accounts are eliminated. C, subsidiary assets and liabilities are not impacted. Subsidiary retained earnings is eliminated. D, subsidiary assets and liabilities are adjusted to fair value. Subsidiary retained earnings is eliminated. And the answer is D, because when pushdown is elected by the subsidiary applies the parent's purchase price allocation on its own books. And this means that the subsidiary revalues its assets and liabilities to their fair values as of the acquisition date. Retained earnings is then eliminated and a new account is created called APIC-Pushdown. And the question asked, in a business combination, if pushdown is selected, which of the following accounts are impacted on the subsidiary's separate financial statements? And the answer is D. Subsidiary assets and liabilities are adjusted to fair value. Subsidiary retained earnings is eliminated. Let's see what the journal entries would look like with this example. January 1st, year 1, parent company acquires 100% of the sub for $1.2 million. And they give us the assets and liabilities of the sub, both the book value and the fair value, and the difference between fair value and book value. We said that if pushdown is selected by the subsidiary, then we're going to use the same parent's purchase allocation, and there might be some goodwill. Let's see. The purchase price paid by the parent, they tell us, is $1.2 million, and the fair value of all the subs identifiable net assets, assets minus liabilities, equals $890,000. The difference being $310,000. That's going to be goodwill recognized by the parent on the consolidated financial statements, and if pushdown is selected, then the subsidiary will also recognize that same amount of goodwill in their separate financial statements. Here's some journal entries. We'll debit goodwill for the $310,000 and credit APIC-Pushdown for $310,000. These entries are made on the subsidiary's separate books. Along with this, we'll debit inventory for the $40,000 difference between fair value and book value. We'll debit property, plant, and equipment for the $200,000 difference between fair value and book value. And we'll credit again APIC-Pushdown. Notice 2 credits to APIC-Pushdown, and that account now has a $550,000 balance. But we're not done. One more entry because retained earnings of the subsidiary has to be eliminated. So they'll have to tell you how much retained earnings was just at the time of acquisition. So let's assume subsidiary pre-acquisition equity consists of common stock, $500,000, and retained earnings, $150,000. A total of $650,000 of stockholders' equity, which matches the book value of the net assets of the sub. Well, under pushdown, we have to eliminate pre-acquisition retained earnings. So debit it for $150,000, get rid of it, and credit APIC-Pushdown, which increases APIC-Pushdown by another $150,000. So if pushdown is selected by the subsidiary, then all 3 of these journal entries will be made by the subsidiary on their separate books, and the exam could ask you how much is the APIC-Pushdown balance after these entries, and you'd have to add up the 3 credits. And the answer would be $700,000 would be your balance in APIC-Pushdown, a newly created account on the subsidiary's separate books only because we're using the pushdown method. If the subsidiary decided not to use pushdown, they wouldn't make any of these adjustments. They wouldn't make any of these entries. There'd be no goodwill to record, no APIC-Pushdown. They wouldn't write up the values of these assets, and they wouldn't have to eliminate their own retained earnings. All right, Pitt Corp acquires Steel Company, and on the acquisition date, Steel has the following: Pre-acquisition retained earnings, $95,000. Carrying value of equipment, $400,000. Fair value of equipment, $460,000. Goodwill from Pitcorp's purchase price allocation recorded on the consolidated work papers is $180,000. Now, if the pushdown method is selected by Steel Corp, how much is the credit to APIC pushdown on the date of acquisition? And the answer is A, $335,000. We'll first step up the equipment to fair value. That's the difference between the $400 and the $460. So $60,000 debit to equipment. We'll record goodwill. They gave us the goodwill from Pitcorp's purchase price allocation. Goodwill is $180,000, they tell us, so that's going to be debited. And then eliminate the pre-acquisition retained earnings. They told us was $95,000. So we're going to make a debit to equipment for $60,000, debit to goodwill for $180,000, debit to retained earnings $95,000, and the credit to APIC pushdown $335,000, and that's choice A. Because the question asked if the pushdown method is selected by Steel Corp, how much is the credit to APIC pushdown on the date of acquisition? And the answer is $335,000. All right, parent company acquires 100% of the sub on January 1st. They don't have to acquire 100. Remember, they could acquire 80, anything over 50%. Subcompany elects pushdown accounting. On the acquisition date, sub's pre-acquisition equity balances are common stock $300,000, retained earnings $125,000. Now, as part of applying pushdown accounting, how should sub record the elimination of its pre-acquisition retained earnings? A says debit APIC pushdown and credit retained earnings. B, debit retained earnings and credit common stock. C, debit retained earnings and credit APIC pushdown. D, no entries required. Retained earnings is not affected. And if you think you know, leave me the answer in the comments section. And remember to like and subscribe. And if you found this video from I-75 FAR helpful and you want to see the end of it and more videos like it, go to i75cpareview.com and get yourself on the right road with me, Darius Clark, because the right teacher makes all the difference. I'll leave a link in the description.